All right. So thank you very much for the invitation. It's great to be here. And since I'm the first speaker in the session, I'm going to start with an observation about DeFi research. So DeFi research is probably about 4 years old. It started together with the DeFi summer in 2020. And there has been quite a lot of good and interesting and impactful papers in DeFi. But so far, it seems like most of the producers and consumers of DeFi research are basically sort of early adopters of DeFi technology in both the academic and the practical sense, right? And not too many people in economics and finance care much about DeFi, right? And the question is how to change this. I think one way to do this is to try to use decentralized finance as sort of a useful laboratory to try to answer kind of more general questions in economics and finance, and kind of in this way to create interest in the area kind of more generally, right? And so this is, this project, this paper is an attempt at that, right? This project is done together with Alex Zidelson, who is the CEO of Secret Labs. So Secret Labs is a blockchain that is focusing on confidential applications, and in particular confidential DeFi. Right? All right, so the talk is going to be about quantitative investments in DeFi, right? So let me start by talking about quantitative investments in general. So this guy is Jim Simons. Many of you probably know of him. He's probably the poster child of quantitative investments, the founder of Renaissance Technologies. And he's famous for generating huge returns using quantitative strategies for several decades, right? This article claims that he has generated 66% return on average per year for many, many years, right? Now, the question is, is quantitative investment profitable in general, right? Or, this is some sort of statistical kind of aberration, right? Now, the answer, well, before the answer, right, let me define what quantitative investments are. So, quantitative or systematic or rule-based strategies are basically those that apply a repeatable and data-driven approach, relying on computers to identify investment opportunities across many securities, right? This is definition by AQR, which is another famous quant fund. Now, in terms of the importance of quantitative investments in general, they seem to be quite a sizable fraction of overall kind of investment landscape. In particular, quarter of hedge fund investments seem to be quantitative. I say seem to be because, it's going to be difficult to identify quantitative investments, and, I'm going to talk about that in a minute or so. So, are quantitative investments profitable in general, right? And, it's hard to measure, it's hard to answer this question, but generally they don't seem to be, right? So the existing research basically shows that the profitability of quant strategies is not better typically than profitability of typical investment strategies. But there seems to be wide variation, in particular in emerging markets. Quant strategies seem to be doing better, perhaps because those markets are less efficient, right? And those types of strategies, have better chance of achieving better outcomes. Now, what kind of strategies do quantitative investments employ, right? Now, it's not very clear. If you go, for example, to the website of Renaissance Technology, you're going to see that it's an investment management firm that employs mathematical and statistical methods in the design and execution of investment programs, right? So they basically say nothing, right? And this is pretty general, right? They're going to be very secretive about the strategies they employ. There is a little bit of research. AQR claims that strategies aren't correlated across different deployers of strategies. And if you look at the sort of high-frequency trading part of this landscape, this seems to be mostly related to market making. Okay? The reason why we don't know much is that it's kind of hard to identify quant strategies. Usually it's based on some sort of self-identification or self-reporting, right? You can read either the prospectuses or just kind of the summary of the investment approach, and by that decide whether, a particular fund or a particular strategy is quantitative or not, right? Bottom line is, in traditional markets, we really don't know much about quantitative investments, and that's why in this project we turn to DeFi to try to learn something about quantitative investments there that could be potentially useful for other markets as well, right? So our setting is in quantitative investment in DeFi, in particular liquidity provision in concentrated liquidity pools, on decentralized exchanges or DEXs, right? This is one of the main or most important types of investment strategies in DeFi, right? And, before going into details, right, just a few words about, why we are looking at this setting, why the setting is potentially better than looking at kind of traditional finance, right? First of all, here, as I'll argue, quantitative strategies are easily identifiable, right? I'm going to be able to distinguish quantitative strategies from non-quantitative ones. I'm going to be able to decompose those strategies into several components, right? So those strategies are going to be quite complicated. There are going to be bets on several things at once. I'll be able to do the decomposition and basically try to see which parts of the strategies are the strategy deployers better at, right, if at all. We see everything, right? We're going to use data from a public blockchain, right? So we see basically all the strategies and all of their outcomes, right? And so it's really easy to look at the whole population of data. And we can compute everything precisely, right? So, a much better in terms of kind of doing any sort of statistical analysis, a much better kind of setting than what we have in traditional finance, right? In addition to this, right, because this setting has this abundance of data, right, both for researchers and for actual investors, right, this is probably the most natural setting in which quantitative strategies can and should strive, right? So this is the place to look at. All right, so I'm sure that most of you or many of you know how this works, so I'll do this introduction to the actual investment strategies really briefly, right? And maybe at the end, we can have some questions. So basically, what happens is there are liquidity pools, and basically those are places where people deposit money, and this money is used for trading, right? There are many liquidity depositors into a given pool, right? So a pool aggregates basically deposits from multiple liquidity providers, right? So there is someone who sets up the liquidity pool in two assets, let's call them X and Y, right? And in concentrated liquidity pools, every strategy deployer can also define the range, for which the strategy is going to be active, right? The range is basically the exchange rate between X and Y, where the strategy is going to be active, where this money is going to be useful for performing trades, and outside of that range, it's not going to be useful, right? The more narrow the range, the more concentrated the liquidity, kind of the more over time each dollar of liquidity works, right? But also the higher the chance that the exchange rate is going to go outside of the range, and then the liquidity is going to be idle and not useful. Now, each liquidity provider can establish and close the position at any time, right? And the reason why they do this is that every trade is going to be associated with a fee, right? And this fee is going to be distributed to all the liquidity providers in the pool in proportion to their liquidity in the relevant range, right? And the concentration of this liquidity, right? So the basic trade-off in this investment strategy of liquidity provision into concentrated liquidity pools, right, is that you want to receive the fee revenue, right? And this fee revenue is going to be increasing in the trading volume in the pool. It's also going to depend on your own position and its concentration and what other people do, right? Their positions and their concentration, all of that is going to affect the distribution of fees across the liquidity providers. However, this is not a risk-free proposition. All the liquidity providers face the so-called impermanent loss. Impermanent loss basically is a loss to arbitrageurs that happens because the exchange rate at which the liquidity is going to be withdrawn from the pool is different from the exchange rate at which it has been deposited, and someone is basically taking profit on that, and the loss is the loss of the LPs. This impermanent loss is a function of the volatility of the exchange rate. The higher the volatility, the larger the chance or the larger the expected amount of the impermanent loss. And it also increases in liquidity concentration, right? If liquidity is very concentrated, then basically at some point, all of the expensive asset is going to be drawn out of the pool or of the position and substituted by the cheap assets. So that is going to be, high loss to the liquidity provider. All right, so let's define a liquidity position. I'll need this definition for basically a decomposition of the different components or parts of this strategy, right? So let's say that there is a liquidity provider, call them I, that establishes a position by depositing X0 and Y0 units of assets X and Y into the pool, right? And then at some point he's going to close the position by withdrawing whatever is left in the position. So he's going to withdraw the same assets, perhaps in different proportions and at different prices, right? In the process, he's going to accumulate trading fees, right? And he's also going to pay some transaction costs, some gas, for establishing and terminating the position, right? And so, this expression here is basically the summary of the return that a liquidity provider is going to make, right? The realized return, right? In the denominator, that's the kind of the money that he put in. In the numerator, the first part is the money that he's taking out. The second part, the summation, is basically the fees that he's going to generate as a result of providing liquidity. And then the last part is the gas costs, for starting and ending the position. Now, let's try to kind of decompose, right, this expression into different kind of sensible components. So it can be decomposed into sort of 4 or 5 different components. The first one is just the holding return, right? So basically, let's say that instead of providing money into this concentrated position in liquidity pool, the person would just buy these amounts of assets X and Y, right, and hold them, outside of the pool. So then we would be basically getting this holding return, right, which again can be decomposed into 2 parts. It's just the market return, right, if we want to talk about kind of market timing strategies, right, or abnormal return for holding the asset, and this is sort of the asset picking strategies, right? Now, in principle, all of this can be hedged, right? If you don't want to take the risk related to movements in prices, right? So the first part can be hedged completely. The second part is the impermanent loss, right? So this is basically the expected or the realized, loss to the arbitrageurs, from movements in prices of the 2 assets. And that can be decomposed into probably 3 components, right? The first one is the expected impermanent loss. I'm not going to derive the expression here, but this is kind of the formula for the expected impermanent loss, right? It's kind of higher for higher volatility assets. There is the abnormal impermanent loss, right? What happens if prices move more or less than predicted. And there is also the concentration part of the impermanent loss, right? The more concentrated the position, the higher the expected and the realized impermanent loss is going to be. The third part is the fee-driven return, right? There as well, you can kind of think about the expected fees, right? If you can, make some model predicting future volume of trading in the pool, right, and future fees. There is the abnormal component, and there is a component due to the concentration of the position, right? And finally, there is the gas cost that can also can be decomposed into the expected and the abnormal component, right? So, if you want to think about the types or potential types of skill in providing liquidity in these particular strategies of providing liquidity to concentrated liquidity pools, right, you can identify those potential skills, right? The first one is the skill in building the concentrated liquidity position, right? So kind of defining the range of the position, conditional on what pools, and what we are going to invest in, and the times of the investment and the withdrawal of the money. The second one is the choice of pools, right? So there are basically, it's 2 bets, right? So it's the bet on trading volume, right? You want to invest in pools with high trading volume, expected and exposed realized. But also you want to invest in pools with not too big of the expected and realized impermanent loss, right? So it's a bet on trading volume and an inverse bet on volatility, right? The third one, you can think about transaction cost optimization, right? So gas prices, vary widely over time, and you can think about strategies of, terminating and establishing positions, at times when gas prices are relatively low. And the last two kind of items are, again, hedgeable, and that is, the asset picking and the market timing, right? So this is sort of, part of the strategies that are also available in traditional finance. All right, so what is the data? Well, the data comes from the largest kind of public blockchain, from Ethereum, starting from May 2021. So that's the first time that a concentrated liquidity pool has been established. So we have over 500 liquidity pool on all DEXs that are basically Uniswap v3 and all of its clones, right? Uniswap v3 is the first decentralized exchange that allowed for concentrated liquidity. Since then, there are many others, and we are using all of them. We have over 1 million, 1.3 million liquidity positions. The typical size of a position is about $50,000. And we have over 60 million trades, and a typical trade is about $7,000. Now, this data is obviously completely public. It's not very easy to use, and in particular, you need to, to make this research kind of meaningful, you need to make a full match between the liquidity provision and withdrawal data and trade data, right? Basically, you need to understand for each trade which liquidity position received which fee, right? And basically, kind of make sure that everything sums up. It's basically also sort of a sanity check of the data. And obviously we get, some external data from, about asset prices, gas prices, and so forth. Now, the first question is, well, how do we identify quantitative investments, and as opposed to just simple kind of investments that are not based on any algorithms? Well, there are several ways to go about it. The most natural ones, right, is basically to go to people who define themselves as quants. And those are basically automated liquidity vaults, right? So they're basically people who design vaults where investors can deposit money. They run some algorithms off-chain to basically decide on the investment strategy, and then execute the strategies on-chain by basically depositing their investors' money into particular pools, right, and managing this money on-chain. You can also think about other types of characteristics of strategies, right? So you can think about the aggressiveness of strategy, right? So, if you're doing like very frequent investment with very narrow ranges, right, it's more likely that those investments are going to be algorithmic relative to not. You can think about kind of the characteristic of a deployer of the position, right? So deployer is basically, some sort of address, right? You can see what kind of investment is done in the past, how many, what types and so forth. So you can try to identify the characteristic of not just the strategies, but also kind of the addresses that deploy the strategies. So the findings at this point are preliminary, right? So we're still working on the paper, but those are the general kind of results that I want to share. So first of all, liquidity provisions typically are not money earning strategies, right? So they typically lose money. Only about 30% of strategies do make money. Now, this seems to be common knowledge in the industry. If you go to crypto Twitter, right, it's full of basically people discussing how unprofitable, liquidity provision into concentrated pools is. So this is not news. Now, it seems like, and this seems to be new, that quantitative positions, define according to the metrics that I discussed before, but we can think of others as well. But so far it seems that quantitative positions are on average not more profitable than traditional kind of positions, right? Now, if you think about instances where the same address is deployed many different positions, so we can do some statistical analysis, right? Only about 2% of strategy deployers have consistently positive outcomes, right? That's a very small number. Now, if you look at profitable positions, right? What defines profitable investments, right? So most profitable investments tend to make money due to efficient liquidity concentration, right? There doesn't seem to be skill in market timing. There doesn't seem to be skill in asset picking, right? there doesn't seem to be even skill in predicting volume or predicting volatility, right? Most of the profits comes from the right kind of timing of entry and exit into a position and defining the range of the position, right? That's probably the most important things, right? And most of the profitable positions seem to be very concentrated in pools with high volatility, right? So those are very kind of precise kind of strategies. Again, very rare. It's not clear whether it's just some statistical phenomenon or there is some skill involved, but to the extent that there is skill involved, the skill is in basically kind of managing this position very kind of carefully in very volatile pools where otherwise it's very hard to make money, providing liquidity, right? All right, now, what are the implications, right? There are several types, right? I'll start with the implications for decentralized exchanges. So if you think about trading in crypto assets, about 85 to 90% of trading in crypto assets happens outside of DEXs. It happens on centralized exchanges, right? This number has been pretty constant over the last 4 years, right? So, if you looked or try to compute this number right after the DeFi summer, you would get to the same 10%, right? So DEXs have not been increasing in their importance, despite kind of the large kind of evolutions or important evolutions in technology, right? And in particular, people thought that when Uniswap introduced this concentrated liquidity idea, right, that would basically propel DEXs because it would make liquidity much more efficient. That has not happened, right? Now, the likely reason for why DEXs have not won yet is that it's expensive to trade on DEXs because we're sort of in a bad equilibrium, right? So, if you provide liquidity, especially into volatile pool, you're exposed to high impermanent loss. And that means that as an investor, right, as a liquidity provider, you want to be compensated, right? So you require high fees. And that means that people are going to not trade on DEXs because, they don't want to pay the high fees. The trading volume is going to be low, right? And that means low liquidity. And that means high impact of trades, which means even fewer trading, right? And even fewer returns to LPs. And this is sort of goes on and on. We're in this vicious cycle, right? And it's very hard to break out of it, right? And the only way to try to break out of it, right? To try to make trading on DEXs as kind of profitable or as desirable as trading on centralized exchanges, right, is to make liquidity much more effective, right? So the effective liquidity must be much higher than it is, right? And that means that liquidity concentration should contribute to the efficiency of liquidity way more than it does right now. All right, and so here I'm kind of previewing a related research that we're working on that's not at the point that I can actually kind of present and discuss it, but we're trying to build a model of optimal liquidity provision, right? It's a continuous time sort of real option model where, we have optimal stopping time for starting a strategy and for ending a strategy. Basically, in terms of kind of contribution to the literature on DEXs, right? So this is basically a model of concentrated liquidity provision with multiple LPs. It's dynamic, right? And there are some adjustment costs that vary over time. Those are the kind of the gas costs. And the hope is that once we're able kind of to finish and to calibrate this model, right? We could try to see whether kind of quantitative strategy defined by clear model, right, could result in more efficient provision of liquidity. But this is for later, right? And hopefully I can share the results at some point later. So what are the contributions of what we're trying to do here, right? I think there are two. So the first one is related to what I started with, right? And that is kind of trying to get some conclusions from DeFi data, and make them kind of more generalizable, right, to general finance, right? So do quantitative strategies outperform, right? First of all, relative to discretionary strategies, right? And that's what we're doing right now. And also relative to kind of model-based strategies that, could be considered optimal in some way. And then also, which components of the quantitative strategies are more and less successful, right? Whether it's, asset picking or timing, or it's market picking and timing, those sort of are the market making strategies, right? or it's the particular strategy in concentrated liquidity, right? Or maybe transaction cost minimization. So far the results seem to suggest that the only skill maybe that's, that those investors possess, right, is the skill of designing kind of the particular concentrated liquidity strategies and probably nothing else, right? And if you think about the contribution to DeFi, right, the big question is, are DEXs going to win, right? Are they going to be more important than centralized exchanges that are prone to a lot of different problems discussed in the literature and otherwise, right? I think the only way for decentralized exchanges to become kind of an important player in this industry, right, is to be competitive with centralized exchanges, right? And that basically means that returns to liquidity provision should be much higher, right? That means that the sophistication and the performance of the liquidity provision strategies should be much better, right? And in this way, perhaps it would be possible to kind of to leave this bad equilibrium, right, of low liquidity, high trading costs, and so forth, right? The only way to do this is through more efficient liquidity, right? And again, we're working on trying to solve for better strategies for liquidity provision, right? Thank you.
Maybe we have time for one pressing question or not? Yeah.
Hi, Professor, thanks for your question. This is Roger from NTU. So the one of your last slide, I think you mentioned about the why can DeFi win. I think you mentioned the two challenges. One is the liquidity. How to make it more effective. Another one is, the trading fee. So honestly speaking, I think the trading fee probably right now is not a problem because of all the layer 2 but I think the problem is actually on the liquidity side. So thanks for introducing a lot of this kind of model, but high levelly, I think one problem that I think this year the whole DeFi run into is two problems. It's the ETF launch of the BTC and ETH. Attract a lot of liquidity out of even centralized exchange and DeFi. And the second thing is also all the layer 2. I think the initial goal for Vitalik is layer 2 taking different kind of sector, but everybody's crowded into DeFi is also segmented. How do you think about it? I think that's probably more even high level problem, right? I mean, it's slightly off the topic, but what do you think about that kind of problem, right?
Yeah. So for the first question, right, the introduction of Bitcoin and Ether ETFs, right, I think it's generally a good thing, right? It draws more people into the industry. In terms of kind of the investment opportunities, right, I mean, people are drawn into places where they can make money, right? So if money can be made in providing liquidity to DeFi pools, I think, funds are going to flow there regardless of ETFs and all that. The second thing is, Ethereum still accounts for about 60% of the volume of all DeFi kind of trades. So I think this is still the right place to look. But you're right that there's a lot of liquidity segmentation, right? So there is probably over 100 L2s right now, and some people say it's going to be 1,000 by the end of next year. Now people are working on kind of connecting this liquidity, right? So there is this project called AgRail, I think, by Polygon and others that is trying kind of to build a system with kind of bridges inside it, across all chains. So all the liquidity is going to be interconnected. Probably at some point this is going to be solved, but I agree that kind of liquidity fragmentation is a problem. It's sort of solved on the level of a blockchain by different aggregators that route trades to different pools, and hopefully it is going to be solved at some point, across different blockchains as well.
Okay, thank you very much, Professor Lyandres.